and went to school at UT, did finance there, was an underwriter for GE Capital for 8 years through 2007 and 2015. And I'll talk about a little bit about that experience as well. And then the last 5 years, I've originated close to $800 million in multifamily debt across 125 properties. And then since 2015, I've invested in about 6,000, 7,000 doors. It's probably been 27, 28 multifamily properties across DFW, Austin, and San Antonio. And then 6 or 7 of those have sold. So I'm about 21 properties right now. So I thought we'd start here. I thought this was a good place to, this is sort of your 10-year treasury minus your 3-month treasury, right? And this gives you an idea of when, sort of starting with the yield curve inversion, if everyone can see that. And I thought it was a good place because, it's pretty obvious when you look at it, right? I mean, it's not that complicated here. Is every time you see a yield curve inversion, there's a downturn coming right behind it, right? So the gray is highlighted are the downturns. So you see sort of, early 2000s, 2008, and then this 2019 yield curve inversion. So even without coronavirus, I mean, it was sort of getting baked in a little bit here that this recession was going to come up. And then this is just reflecting the Dow, 2001, 2008, and then where we are sitting today. And then, I mean, we're in Texas, so the price of oil has just, I think, added on to this effect. And, coronavirus is the first, the first leg, and now oil's down. I don't know what the price is now, $10, $15. So it's just getting hammered this year so far. And so here was the interesting thing that I saw in terms of on the financing side, right? So when we look at the credit cycle, even though I had been in lending for a long time, until I read this, I had never seen it in this way. And so Howard Marks does a good job of explaining this in his memo. He says, all right, so the first 6 steps are really the upside of the credit cycle, right? So you're seeing prosperity. There's a lot of capital in the market. There's no bad news. And essentially more and more institutions are in the business of providing loans, right? And what happens, and we saw this in 17, 18, 19, is that the only way that lenders can compete is by cutting interest rates and lowering their credit standards and providing higher LTV. So what we saw was people were moving away, let's say in the apartment space, from Fannie Mae and Freddie Mac and moving into bridge loans and going higher leverage. So whether that was 75 to 80% to 85% leverage, and those were going to people who didn't necessarily have the track record to substantiate it, right? And so I would say March of 2020, we flipped over to the other side, right? So losses now haven't happened yet for lenders, all right? So that step one has not happened, but almost everybody sees it coming, right? So on the CMBS side, in terms of hotels and retail, I mean, the number of people who did not pay their mortgage is going to increase significantly on the CMBS side. And the CMBS market is really the market for non-multifamily. It's really your hotels, your retail, your office, your industrial. Though that CMBS market is going to get hit, and there's going to be a lot of losses in that space. And so, step one is lenders see the losses. Number two, risk averseness rises, right? And there's going to be, higher interest rates, more credit restrictions. There's going to be covenant requirements. So you saw Fannie and Freddie in the last 30 days essentially come out and say, look, we want you not only to be 75% levered, but we also want you to put up a 12-month interest reserve or 18-month interest reserve. So you already see we're in that step two of credit restrictions, covenant requirements, and then less capital is being made available. So on the apartment side, I'm going to use the apartment side because that's what I'm most familiar with. But like Freddie Mac, small balance lenders, they basically, there's 12 small balance lenders, and half of them are saying, look, we're going to add an additional layer of risk right now. And what that means is you might have been underwriting deals. Freddie Mac might do a deal at 75%, but they're only going to do a deal at 70% or 65%. And Freddie Mac might have done a deal in a small market, but now they're not going to do deals in small markets anymore, only major markets. And so people are going to start seeing less capital available, and it's only going to go to your best borrowers. So we're probably right in that number 2, number 3 of the credit cycle. I don't think we've hit number 4 yet, where companies are starved for capital and borrowers are unable to roll over the debt. So right now we haven't seen that. We haven't seen, it hasn't been long enough. We're only 1 month into this thing. I think once, if it goes to 3, 4 months where tenants can't pay and owners don't have the cash reserves, that's going to start leading to foreclosures. But eventually, once the foreclosures work their way through, it's a couple of years later, then people start bringing more capital into the market and people will start giving loans at 8%, 9%, 10%. And eventually that gets whittled down because more and more lenders come into the market. And then it starts back up to the top of the positive cycle and the economy starts moving again. So I would say it's sort of like 5 and 6 of the negative side. That was really 2008, 2009, 2010. And then not until maybe like 2012, 2013, did it really start coming back in terms of the credit cycle. So I thought this was super interesting. I had never really seen it this way. Even though I had been in lending, I had never seen it sort of articulated this way. And you can see that this is sort of like a self-fulfilling cycle. It just keeps going over and over again. A couple of things. I went back and looked at a couple of the memos that Howard Marks had from 2001, 2008, and they could have been from 2020. Some of the things that he talked about was consumer psychology. I just saw a chart today. Basically, consumer confidence dropped from, I think it was like over 100 all the way down to 70. And that's essentially in 1 month. And that was, that's in the depth of the financial crisis, 2008, 2009. It was in the exact same spot in terms of consumer psychology. Lenders' willingness to lend. I mean, I'm seeing it right now. A lot of lenders are pulling back. And then investor confidence, right? So the ability to go out and raise equity right now, all of those have taken a beating. And then this piece of it, right? Success, which has been the last 4 to 5 years, carries within the seeds of failure. And then the failure, the seeds of success, right? So as the next 12 to 24 months come through, there's going to be a lot of failures, but in that, there's going to be seeds of success. Howard Marks talks about the third stage of a bear market. And in that third stage, everyone agrees that things can only go wrong. Okay. And right now, all you hear on the news is negative news, right? Like almost no optimism, nothing is being priced in for optimism right now. And, you can buy assets at prices that reflect little or no optimism. And so I think in the stock market, that was probably like 2 or 3 weeks ago, right? So when prices had dropped, I don't know, the Dow it went from 29,000 to 18,000. So it was down like 30%. I think that's when Howard Marks came in and bought a bunch of stuff. And he said, look, even if if I'm trying to catch a falling knife here, this value he felt comfortable at because there was no optimism really baked in at that price. But real estate's a little different, right? So there hasn't been that falling of a knife yet. People have not got desperate. People have not had to sort of fire sell assets yet. And so we have not seen prices drop. Right now, there's just been a dislocation between buyers and sellers. So this is his, all right, how do you take advantage of opportunities like this? And number one is you figure out what the intrinsic value of an asset is. And then when the price falls below that, you buy it. And then even if the price falls more and more, you average down into that. And then you have to be right about value. And so in 2008, he says, in a few years, we'll reminisce about how easy it was to take advantage of these bargains. And so I did this for DFW, and it looked at the sales price per door and how they got hit in the market. And, starting with sort of your Class A, 2008, 2009, those saw a pretty big drop, right? So it went from 134 a door all the way to 82 a door on average. And I see the same thing happening on Class A property and lease up right now. So in DFW, we have probably about 25,000 units that are supposed to deliver this year. And then probably another 20,000 that are under construction. And so if you look on the far right, it was Class A deals were up to 170 a door. So I think there's going to be, number one, it's going to be tough to lease these properties up. So it's going to take longer to lease them up. And then I see that dropping back down to probably 2014, 2015 pricing. So maybe 140, 150 a door. So there was about a 50 a door drop from 2007 to 2009, and then it comes back pretty strong. But you can look at your Class B properties, so sort of this upper middle range, low middle range. They essentially, they went down a little bit, right? So it went from 82 a door in 2008 to 75, but essentially went flat and then came back very strong. And then it took the lower end, so I would say your C minus D properties, it really stayed flat for 8, 9, 10, 11, 12, 13. It was 18 to 20 a door and didn't really move from that. But then in the last 5 years, it accelerated. It almost tripled in price. And so I think that's probably where you're going to see most of the hurt is your Class A stuff on the top and Class sort of C minus D stuff on the bottom. The B stuff, I think, is going to be pretty safe. You might see a 5 to 10% discount on that, which we're seeing already. But I don't think it's going to be a 20, 30% drop like some of these other asset classes. And so on the bottom here, bottom right, I put in a chart of GDP. And you can see that there's 2 consecutive quarters of negative growth, sort of late 2008, 2009, and then we went positive after that. And so one of my rules, and maybe we'll talk about rules later, but one of my rules is I want to see 2 consecutive quarters of positive GDP before I reinvest into a deal right now. And so I think Q1 is going to be negative GDP, Q2 is going to be probably negative GDP, and then Q3 is up in the air right now.
Hey, James, sorry. Yeah, could you? I love this slide. Thank you. Okay. Can you just talk a bit more about the drivers of these prices? I'm a bit surprised on the workforce upper and lower because the last time we saw you, it was obviously just a month of data, right? Yeah. I think there was a slide that we went through last time that showed the C's. Certainly for the month of March with like as low as 60% collections. Sure. But the A's and B's were collecting 90% plus, right? Yeah. So this is great testament to workforce at least. But can you talk us through a bit more the drivers of the price declines and I guess in the case of workforce, it didn't change much, certainly in the 2008 era.
So really it's a function of rents. Yeah. And I don't think rents came up. I think rents were essentially flat in 8, 9, and 10 in the workforce and even the upper to low mid range. I think the rents just ended up being flat for like 3 years from 2009 probably to 2012. And then 2012, that's when rents just started really ramping up. And what we ended up seeing was a combination of rents increasing, but then also cap rates compressing. And so what we saw was, and I don't have a cap rate chart here, but cap rates on the A stuff, essentially, even in 2012, 2013, were like 5%. Okay. And the B stuff was 7, and C, the workforce stuff was like 9. So in 2012, you could go buy a deal at a 9% cap, right? But then what happened was cap rates compressed across 2000, even from, I would say probably 2013, 14. All of a sudden there was a gap between C to B to A, and the gap was probably only 1%. Like an A deal you could buy at 5%, B deal at 5.5%, and a C deal at 6%. And so that's what caused that price per unit to skyrocket. because rents were going up and cap rates were compressing at the same time. And so, yeah.
Clifton asked a good question. 2010 for workforce lower, that there was a 10,000 number. Is that an aberration or what happened there?
I don't think there was many trades in.
Yeah, I see.
In 2000, like, I mean, I'm working on a chart for like the sales volume, and I mean, I can pull it up if you got a second. I can just try to pull it up. I had it in my deck here. I haven't put it on a sheet yet, but I had it. Here you go. I was working on my next. So you can see here, I'll make it bigger, but essentially look at the number of transactions in 2006, 2007 for apartments. And in 2009, it basically goes to $1 billion in transactions for all of DFW, right? In 2010, $1.5 billion, $2 billion. I mean, the last 17, 18, 19 have been close to this $9-10 billion level. It's essentially been flat the last 3 years. So down here, there just wasn't much to trade in that space.
I see. Okay. So going back to that slide, it seems to me the collections for the C's are worse than B's and B's worse than A's. And it seems to me the stimulus package, including the 350 that evaporated in the next stage, are not really channeling down to the lower income folks, right? So again, this chart, except for 2010, it's slightly surprising to me because it seems to me the lower income folks would be hurt more, and therefore the cap rates would hurt as well. But if I'm reading this, this is a strong testament for workforce. Can you kind of talk more about that and maybe?
So this is historical. Yeah. This is not as of now, right? Mm-hmm. And so I think today's going to be a little different. So this is another slide that a broker sent out today. Can you guys see that?
Can you blow it up?
That's as big as I can get it.
Okay, talk us through then.
So essentially, with the CARES Act, they added 600 a week in unemployment. And so you can see on this chart, essentially 55,000. Let me see if I can make it bigger. So at 55, anybody making less than $55,000, they're going to make more on unemployment for the next 3 months than they did with their actual job.
Yep.
And most people's rent, let's say it's 30% of your income, most people's rent in the sort of BC space is going to be anywhere from the $750 all the way to, let's say, $1,400. And they're going to receive anywhere from $4,000 to $5,000. So this is what people are counting on for May, June, and July. So I don't think there was a program like that back here in 2008, 9, 10, 11. I think people got unemployment, but I don't think they got that extra $600 a week. And then I think these cap rates on the lower income side, the C and D properties, those cap rates are going to go back and expand, I think. So that price per door is going to come down more so than the upper mid range, which is more your B product.
Okay.
All right. So I got some lessons from Howard Marks. I like this slide a lot. We can go into it, but he talks about risk, and I was in risk for 8 years, and nobody ever told me anything about risk the way this chapter did. And so this is from The Most Important Thing by Howard Marks. And, he said, investing consists of one thing, dealing with the future. And none of us can know the future. So the best job is to control it. And this chart in the upper right gave me the best idea of risk, right? So as you move out the curve on risk, it's not only that your projected return should increase, that's obvious, right? But your range of return also increases. And so let me give you an example. In multifamily, let's say you buy a deal, you put, a 10-year Fannie Mae loan on it, it's a stabilized property. Your return, let's say, is 10 to 15% IRR in this range, right? And it might go to 20, it might go to 10, but the chance of you losing money on that deal is actually pretty low, right? But then as you move further out the risk curve, let's say you buy a property that's 50% occupied, it needs $10,000 a door in rehab, and you do a bridge loan, and your expected return is 20 to 25% IRR. Yep. So your projected return is right here at 20%, which is higher than my projected 15%, right? But the chance of you going to 40 is higher, but then your chance of going to 0 is also higher. And so the way I think about risk now is it's not just the projected return, because the projected return is never the actual return that you get. It is a range of returns. And thinking about risk in that way, and risk equaling volatility is how I think about risk now after seeing this chart. So that was a big thing out of his book. And so this is, one of the things that Howard Marks talks about is sort of knowing where we are in the cycle. And the way he describes a bull market, the way he describes a bear market here, the bull market, I think everyone gets, a few people think, things are going well, then most investors jump in. I would say that's 2013, 14, 15. And then, probably 17, 18, 19 was, number 3, the third stage, when everyone concludes things will be better forever, right? Whereas the bear market, there's a few thoughtful investors. I would say that's probably even beginning of 2020, maybe 2019 was when a few people are just like, look, things aren't always going to be rosy. And then I would say in Dallas, the last year, there's been, pretty minor, if any, rent growth, right? So some investors started seeing that, recognizing things are deteriorating. And then to me, we're in this final third phase, right? And, everyone's thinking that there's only bad news right now. So to me, if you look at this chart on the right, you're sort of in between, I would say, fear and panic right now. Because essentially in March, I had 4 or 5 deals. People were best and final. And then once Trump came out and sort of said, look, we're shutting all travel down from Europe, from everywhere. And I think that, that ignited the fear. And then I think people are still sort of in a panic right now. And I have not seen many deals. They've come to market, but I haven't seen deals sort of put together right now. So I think we still got a little bit more time before we go from panic to depression down here. And before we get back up.
Could you show the slide in full view as a request, James? Is it already in full screen?
It's full view on my side. Yeah.
Yeah, I think it is. Yeah. Okay.
But I can send out some slides after if you want. So that's, I would say, risk cycles. And this is probably going to be hard to see, but this is a guide to market assessment. And, I think looking at the economy, capital markets, what investors are doing, sellers and buyers, and I'm going to probably do this on a quarterly basis, is do a market assessment of where things are. Because I think that's gonna help you pick the right time to be into deals. And so if you look at this chart, everything on the left-hand side, economy is vibrant, plenty of capital, plenty of buyers, strong asset prices, and there's a lot of, general partners that essentially hold all the cards. That's when you're in a bull market. And then on the bear market, it's pretty much everything's the opposite. And so it's not going to be perfect, but I think this will give you a good idea in terms of, where we stand in the market. Let's see if there's, so I got 2 more slides here, I think. And, people in Texas are familiar with Trammell Crow. People maybe outside of Texas, they've seen their buildings, but Trammell Crow is probably one of the biggest developers here in Texas. And the late 80s, sort of after the tax laws changed, Texas got pummeled during the S&L crisis. And we had more development. So just to give you an idea, in the 80s, so right now in Dallas, Fort Worth, we're building about 20 to 30,000 units per year, okay? In the 80s, they were building 70,000 units a year in the 80s. And we didn't have nearly the population. And so there was a big downturn in sort of late 80s. And the CEO of Trammell Crow basically went out to everybody and said, look, what would you guys tell yourself if we could go back 4 years or 5 years? They're in the good times, they're in the bad times. So these were some of the lessons learned. So during the tough times, number one, cash, right? Cash is king. And failing to hold some of that cash back and instead of making distributions was the mistake that they made. Failing to retain cash to not be in preparation to have buying opportunities was another mistake. In terms of negotiation, document everything. And because, when deals go bad, memories become very short. On the debt side, they're really focused on working with the best lenders. And in timing, this one's important, is, you don't know how far this thing is going to drop. And so if you come into a deal and let's say I've already seen this today, someone sent a deal out and said, look, are you willing to buy this deal at a 10% discount from what we were going to sell it for a month ago? And some people are ready to jump at that, but you have to have the staying power to make it through, because if this downturn goes 12 months, 24 months, 36 months, you don't have the staying power, you're gonna get eaten up like a fish. All right. So you got to have the staying power. And for acquisitions, they always looked at replacement cost versus purchase price. And then during the good times, they said, look, let's do fewer deals, and let's make sure we manage those deals right. And we should sell more deals in the good times, because like we saw sort of middle March, as soon as the market becomes soft, there's no more buyers. And so sometimes it's better to sell too soon. Their focus is really being in the field. So being close to projects, being near tenants, and their debt. So they were developers. They almost always did recourse debt up front and then moved to non-recourse. But sometimes they took on more recourse debt instead of moving to non-recourse, when they should have been paying attention to that. And then in terms of team, they said, one superstar, is greater value than unlimited number of mediocre performers. So those were some lessons from Trammell Crow. That's all I had. Those were some slides that from sort of the last, I would say, month or so of webinars that I've done, and just to give you an idea of sort of what I'm thinking. So hopefully that was helpful and gave you sort of some perspective on what I'm seeing.
That's great. Thank you. The slides get better each time. I wanted to drill down a bit more on some of these, but I want to ask the audience as well. I think I know the answer, but I'm just curious. Maybe just guys can type it in. What do people see as, are we at the bottom? Maybe just kind of type in what you guys think. Or do you guys agree with what James said? We're really still in the panic stage, and we're still quite a bit far off from that. I'm just curious what folks here are thinking. And then the other questions are, is anybody here actually buying or just kind of looking? Just curious. Anthony, I know Clifton, you guys are active, and particularly in real estate. The folks that are doing real estate here, if you don't mind just kind of sharing your thinking.
Yeah, I could take that real quick. So if we're active, it has to be the right opportunity
Sure.
moving forward. And I have seen some price adjustments from sellers who brought out property 2 months ago where they were all the way at the top and they had a buyer for it, and the buyer fell through when in the midst of all this going on. The broker kind of circles back to other buyers, and in some cases, it's been pretty significant discounts. But for the most part, to kind of um, piggyback off of James' presentation, I particularly deal with the kind of the upper end workforce, maybe even B minus.
Mm-hmm.
So in terms of fluctuation, there hasn't been that much there, which kind of rings consistent with your presentation. But James, as you presented, we don't really know where we are. I think we're pretty close to the bottom. I'm not. We're probably a little past the fear, and people are panicking. So I guess we'll see what happens. But it's more of, as an operator, you got to be selective with new projects. And to be honest, if you're an operator, you should be pricing in an event of a recession happening into your model. Just like James said, if the numbers still work and the return's still decent, if there is a recession, you should always have that sensitivity analysis done in the first place to so you don't get hurt in times like these. So
Sure.
Everything James said basically is true.
Yeah. Anthony,
okay. Can I?
What I'm trying to figure out with general partners right now is, let's say like there's a deal. Let's just try to use easy numbers. Someone bought a deal, it was like $11 million in 2007 or 2017. They ran into trouble. Now they're undercapitalized. They've been in the deal a couple years. They're only 80% occupied. Then COVID hits. Okay. And you can come in, broker saying, look, you can pick up the deal, assume the debt is $8 million. You can put $1 million down, or $1.5 million. You can buy it for $9.5 million. But it's probably 60% economic occupied right now in terms of people paying. And you're probably not going to get a lot of leases for the next 6-12 months, new guys coming in the door. And how do you, how much of a reserve? So if you did a new loan, Fannie and Freddie are going to say you need 12 to 18 months of interest reserve. But what I'm telling general partners is you probably need to raise that money now and put it in your own bank account, because you don't know if this is going to take that long to sort of flush through. And if you come in and you buy it for $10 million or something like that, assume an $8 million loan, and then you end up going down the tubes here and run out of money in year or two of this, you might have to sell it for $9 million.
Yeah. And if I could say one thing again, Sam and James, and I would encourage, if operators have deals, and this is this is a small group, so I'm allowed to talk about this. Personally, I have a deal under contract, and you got to get creative. If the numbers still make sense in the midst of all this, I would encourage other operators to talk to the seller, see if they'll hold a note back for the reserves, or like James said, an operator could raise it, but I would put the burden on the seller, especially if they're motivated still to sell. Try to get a price discount if you can, in my example, I actually got the seller. I said, I need to do an agency loan. It's the only liquid option right now. As James mentioned, bridge was very readily available at very low cost. I said, it's actually better because it's a lower interest rate on the agency. So I said,
Absolutely.
if you still want this deal to move forward, you put up the reserve, and then, we'll draw down on it. Freddie Mac is only requiring 6 months, and Freddie's requiring 12 to 18. So it really depends on what lender, what leverage you're at anyway. So, but it's changing every day.
Oh, yeah.
Yep. I wanted Clifton. Do you mind sharing? Clifton in LA. He's I guess the industrial king, right? Clifton's done a lot of industrial deals. Could you share it from that asset class standpoint, what you're seeing, what your thinking is? You might have to unmute or put on. And while he does that, James, do you guys? I know you guys do plenty of multifamily, but do you do other asset classes like industrial as well? Before
I did while I was at GE Capital, but I have not done any industrial here at Old Capital.
Okay.
Yeah, I think the charts I've seen in terms of rent collection, I think industrial was like 99% of their rent was collected, and I think multifamily was 93, right? So on average, so far, sort of month over month, I think the only deal. Clifton, are you in California?
I'm in California.